Welcome back to the deep dive. So I want you to start by picturing the most boring object you can think of. Maybe a hex nut or a galvanized screw.
The literal nuts and bolts of the world.
Exactly. The kind of stuff you just, walk right past in a hardware store. But here's the idea for today, and just bear with me for a second. If you know exactly where those screws are going and who's buying them, and more importantly, how they're buying them, you don't just have a sales receipt.
You have something much more powerful.
You have a high-tech crystal ball for the entire global manufacturing economy.
It sounds a little like hyperbole, I know, but it's really not. I mean,
Yeah.
these fasteners are the atomic unit of the physical world.
Yeah.
You can't build a car, a plane, anything without them. And the company we're looking at today, Fastenal, moves billions of them.
We are digging into Fastenal's Q4 2025 earnings report. It just dropped on January 20th, 2026. And we have the full stack of sources here, the official call transcript, all the data tables, the press release.
And our mission today is really to solve a puzzle, because the industrial economy right now is, well, to put it mildly, it's sluggish.
Yeah.
Output is flat.
Well, just grinding along.
Right. And yet, Fastenal is somehow posting double-digit growth.
Yeah, that's the part that really jumped out at me. I mean, how are they sprinting while everyone else seems to be walking through mud?
That's the question. So we need to figure out how they're doing that. And the answer, it tells this fascinating story about the future of work, about digital supply chains, and yes, about thousands and thousands of vending machines.
I have been waiting to talk about the vending machines. That just feels like the most sci-fi part of this whole thing. But okay, before we get to the cool tech, let's set the scene. We have the Q4 numbers right in front of us. What are the big headlines?
The big headline is resilience. For the full year 2025, Fastenal hit a record $8.2 billion in sales.
Wow.
And for Q4 specifically, they brought in $2.03 billion in net sales. That is up about 11% year over year.
Okay, stop there. 11%. I mean, if this were a tech startup, maybe that's average. But for an industrial distributor selling metal parts, that feels huge.
It's very significant. Their earnings per share EPS was 26 cents, which met expectations. Now, I should say, if you want to be a real stickler about it, they did technically miss the revenue expectation by a hair, about $17 million.
Which on $2 billion is basically a rounding error, isn't it?
It is. The market barely blinked. But the reason that growth is so impressive isn't the number itself. It's the context. The economic backdrop for this was just terrible.
I saw this in the transcript. They kept bringing up the PMI, Purchasing Managers Index. I know it's a standard metric, but what does it actually tell us?
So think of the PMI as the pulse of the manufacturing sector. It's a survey of factory managers. Are you buying more stuff or less stuff than last month? 50 is stable.
And anything under 50.
It means contraction. It means the manufacturing economy is actually shrinking.
And where are we right now?
We are in the low 48s, and we've been under 50 for a while now. Industrial production is basically flat. So logically, if you're building less stuff, you should be buying fewer screws.
Right. If I'm not making cars, I don't need lug nuts. So how is Fastenal's boat rising when the tide is clearly going out?
That is the million-dollar question. And the answer is market share. They aren't riding a rising wave. They are taking water from other people's pools.
That sounds aggressive.
It is aggressive. They are eating their competitors' lunch. There was this great quote from the CEO, Dan Florness. He said, "We'd welcome a green shoot or two."
Which is such a polite Midwestern way of saying the economy is giving us zero help right now.
Exactly. They are growing despite the macro environment, and they're doing it by changing the whole relationship with the customer. They're not a store you visit anymore. They're a logistics partner that lives inside your building.
And that brings us to the vending machines, the mechanism of the takeover. In the report, they call it FMI, Fastenal Managed Inventory.
This is the secret sauce.
Okay, break this down for us, because when I hear vending machine, I'm thinking of a Snickers bar getting stuck and me banging on the glass. I'm assuming that's not what's happening at a Boeing factory.
Not quite. Imagine a really rugged machine, but instead of candy, it's full of rivet guns, safety gloves, grinding wheels, you name it. And it's sitting right there on the assembly line floor.
So a worker needs a pair of gloves. They don't have to walk all the way over to some supply cage.
Nope. They walk up, scan their employee badge, and the machine just dispenses the gloves.
Okay, that's convenient for the worker, sure. But why is that a game changer for Fastenal's business?
It's the data. The second those gloves drop, Fastener knows. The inventory count updates in the cloud instantly. When the machine gets low, a Fastenal truck is automatically sent to refill it. The factory manager doesn't do
That's just
anything.
Pipkins. It removes all the friction.
It removes the friction, and it creates what we call a digital moat. In Q4 alone, Fastenal signed nearly 6,000 new devices. Their total installed base is now over 136,000 units.
136,000 machines. That is a massive footprint.
It's huge.
Yeah.
And just think about the psychology of that. If you're a factory manager and you have these machines bolted to your floor, your entire workforce is trained on them. Are you really going to switch to a new supplier to save a penny on a screw?
You're not. It would be a nightmare to rip those out and start over.
Exactly. It creates this immense stickiness. You're not just buying a product. You are integrated into their entire nervous system. And the numbers show it. In Q4, 46.1% of their total sales came through these FMI devices.
Almost half their revenue from machines that are literally inside the customer's building. That's wild.
And if you zoom out even more and you include their e-commerce and other electronic sales, what they call their digital footprint, it's now 62.1% of all sales.
So you really shouldn't see them as a hardware store anymore. I mean, they look more like a tech logistics company that just happens to sell hardware.
That is exactly the right way to look at it. And that shift helps explain the next big trend in the report, which is, well, it's a bit more controversial. It's about who they're choosing to do business with.
This was the part of the report that felt a little ruthless to me. It really seems like Fastenal is breaking up with the little guy.
Ruthless might be a strong word, but unsentimental is definitely accurate. If you look at their customer segments, there's a very stark divide.
So let's start with the key accounts. These are the big fish, right?
Really big fish.
Yeah.
Huge national accounts spending over $50,000 a month. Sales to that group rose 14%. They're now over half of Fastenal's total revenue.
And the minnows?
Well, the all other categories, specifically the small customers spending less than $5,000 a month, that's shrinking. The number of those customer sites is down 7.5%.
So they are actively shedding small local machine shops. Why? I mean, isn't all money green?
Well, not all money costs the same to earn. And this gets to their on-site strategy. They're closing traditional retail branches and opening these little micro stores inside big factories.
A gated community for screws.
Precisely. But this creates a very tricky financial dynamic, and I think this is the aha moment of the whole report. It's this trade-off between gross margin and operating margin.
Okay, walk us through this. I saw their gross margin dropped a bit, down to 44.3%. Usually when margins drop, that's a bad sign.
It can be. Gross
Sure.
margin is your profit on the item itself, the markup. And the reason it dropped is simple. Big customers demand discounts. General Motors isn't paying full retail price.
So as they get more big customers, their markup per screw goes down.
Correct. And that sounds bad for business,
It does.
unless you look at the operating margin,
Yeah.
which remained resilient. Their overall operating profit is actually very healthy.
How does that work? You make less per item, but keep the same total profit.
Efficiency. It's all about operating leverage. Think about the cost to serve a customer. A retail branch has rent, a cashier, heating, lighting.
All that overhead.
Right. A small customer walks in, buys $20 worth of bolts, and asks for advice for 10 minutes. That is an incredibly expensive transaction for Fastenal
Versus the machine.
versus the on-site model. You have a machine inside a factory. It dispenses $50,000 of product a month. There's no cashier, no credit card fees on every little purchase, no small talk. It is pure volume with almost zero friction.
I see. So they're deliberately taking a lower gross margin, or the markup, because they're getting a drastically lower operating cost. They're trading markup for efficiency.
That's it, exactly. It's the Amazonification of industrial supplies.
It really is, and that takes incredible discipline. If you lower prices but don't cut your costs, you just go broke.
Which brings us to the human element of this, the leadership.
Right. It seems like the theme here is stability. There's a leadership transition happening, but it's designed to be as boring as humanly possible.
Very much so. The current president, Jeff Watts, is taking over as CEO in July.
And a new CFO, Max Tunnicliff. This was actually his first earnings call.
And he did exactly what you'd want a new CFO to do. He was clear, concise, no drama. Investors love boring. They hate surprises from a company this efficient.
Although speaking of surprises, there was a great little story from the current CEO, Dan Flordes, about a moment of panic he had. I thought it was very revealing.
Oh, I loved this story. Yeah, it's a rare peek behind the C-suite curtain.
So he says he opened his email recently just on his phone, and he sees a message from a colleague with the subject, "Weather is killing us this month."
And you have to pause there. For a logistics company, weather is the ultimate enemy. Snowstorms shut down highways, trucks get stuck. If you can't move the product, you don't make money.
So he said his heart just sank. He felt that pit in his stomach thinking, oh no, January is ruined. The quarter's already in a hole.
He's probably imagining the stock price just tanking.
Exactly. But then he looks closer at the email's timestamp, and it wasn't from 2026. It was an old saved email from January 2025 that he had just stumbled on by
A
accident.
ghost from the past.
A ghost email. The punchline was, current weather is fine. Business is fine. But for that one split second, he felt that terror.
It's funny, but it also shows you how fragile these supply chains can feel. One bad blizzard can wreck a quarter. And actually, they did deal with a big disruption this quarter, the holiday hangover.
This was about the calendar, right? With
Yeah.
Christmas and New Year's falling midweek.
Yeah. Both holidays were on a Wednesday. So factory managers just said, you know what, it's not worth firing everything up for 2 days just to shut it all down again.
Right, it takes too much energy.
It does.
Yeah.
So they just shut down for the whole week. And Fastenal said the number of customers who did full shutdowns literally doubled this year.
Doubled.
From about 10% in a normal year to 20% this year. 1 in 5 customers just locked the doors. That hurt their December numbers, but they were very clear. Don't panic. It's just the calendar. The demand is still there.
So, looking ahead, they survived the holiday hangover, the ghost emails. What does 2026 look like?
They're projecting a lot of confidence. They set a target for double-digit net sales growth for 2026.
Which is ambitious, given the sluggish economy we started with.
It is, but they are putting their money where their mouth is. They're increasing their capital expenditures, their CapEx, to 3.5% of sales. They're buying more trucks, building more hubs, and making more FMI machines.
There was one other shift in the data that I thought was really telling for the long term. They said direct products are growing faster than indirect products. We should probably define those.
Yes, this is a subtle but really critical distinction. So indirect products are MRO maintenance, repair, and operations. That's the toilet paper for the bathroom, the safety glasses, the janitor supplies.
Stuff you need to run the factory, but it doesn't end up in the final product.
Exactly. But direct products, those are the OEM fasteners. The specific engineered screw that goes inside the car engine that the factory is building.
And why does it matter that they're selling more of that direct stuff?
Because it makes them even stickier. Think about it. You can change your toilet paper supplier tomorrow. No one cares. But you cannot easily change the supplier of the specialized bolt that holds your engine together.
Oh, right. That would require new testing, safety validation.
It's an engineering decision, not just a purchasing one. So by moving into direct products, they are embedding themselves deeper into the actual design of their customers' products.
They aren't just the janitors anymore.
Yeah.
They're on the assembly line. It's another layer to that moat.
It creates a dependency that is incredibly hard to break.
So let's wrap this up. We have a company outperforming a sluggish economy by just aggressively taking market share. They're shifting from being a retailer to a digital on-site partner. And they're winning the biggest accounts by trading a little margin for a lot of efficiency.
That's the summary. They're streamlining themselves into a highly efficient machine.
It's an impressive business case. I mean, the execution seems flawless, but it leaves me thinking about that little guy we talked about.
And that's the provocative thought I want to leave you with today. Fastenal is being perfectly rational. They're being efficient. But in doing so, they are systematically shedding small customers because those customers just aren't efficient enough to serve anymore.
They're actively choosing to direct their resources away from the local shops and toward the giant.
Right, and you hear all this talk about how small business is the engine of the economy, the source of innovation. But what does it signal when one of the biggest industrial suppliers basically decides the little guy is no longer worth the trouble?
It's like the infrastructure itself is starting to turn against them.
Exactly. If the supply chain is being optimized purely for the Boeings and the GMs of the world, where does that startup manufacturer go? Where do they get their nuts and bolts if the big, efficient suppliers won't return their calls because their order is too small?
It sounds like the gap between the haves and the have-nots is getting baked right into the physical supply chain.
It is. And that could reshape the industrial landscape for a long, long time. We might be heading toward a world where it's harder than ever to start a physical product company simply because the logistics network has moved on without you.
That is a heavy thought. Something to chew on the next time you pick up a simple screw. It might look boring, but the system that got it to you is changing the world. Thanks for diving in with us.
Always a pleasure.
Look at the nuts and bolts differently, everyone. We'll catch you on the next deep dive.